You are famous as being the $10,000 gold man. You've called for $10,000 gold, and you've made waves on the internet with that call. And people support your justification for why gold is going to hit $10,000. We're going to talk about that and revisit your call again. But first, let's talk about recent price action. So, as you know, gold has tapered off from its highs in August. It's we were talking about this offline. It's very closely mirrored the price action of 2011, where it hit a high, went back down, hasn't recovered since. So, my concern is whether or not this is going to continue. It's going to keep falling down to 2015 lows, stay flat for years. Do you think that could happen?
No, I don't. It can't stay down for years, I don't think. I'll explain why in a minute. But I to go back to your original point, the first call that lit the internet up was 3,000. Now I've taken it to 10,000.
Okay.
It's gone up so much. But 10,000 sounds crazy, I know, but it's easy to get to. And that is, I look at gold not in terms of the dollar price of gold. Gold is the most stable monetary medium there ever has been. And that's why it's been money for 4,000 years. And so really it's a dollar moving around, not gold. Gold's pretty constant. I don't think gold goes to 10,000 in a vacuum. It means the dollar is going down significantly. So I think of gold in terms of the Fed's balance sheet. You look at that metric, how much, what percentage the Fed's liabilities is backed by gold, and we're in a historic low, 6%. And this happened before. It happened in 1969. It got down to 12%. By 1980, it was at 100%. In other words, the gold price went to a level that made the Fed totally backed by gold. At that moment, in 1980, the market, not the politicians, not the economists, the market had returned us to a gold standard. Every dollar Federal Reserve note was backed 100% by gold. That will happen again, and those numbers are up in the $20,000 an ounce level. But that's a total liquidation of the Fed. That's the long term. We're going to get there. When and how is the big question. And I think what people are concerned about is if we look back at the last time the Fed was very active in the monetary sphere, i.e. 2008 and 9, gold had a tremendous run up to 2011, 12, and then it had a big bath and stayed low for a while. I think what we're living through now is very different than that. That was a bank problem. The banks, as we all know, were over levered. They had crazy, it's 50 to 1 leverage in the housing market when they blew up. The Fed printed money. What they really did was they created reserves. They gave the banks reserves to bail the banks out from the previous bets and allow the banks to make new bets. And those new bets created a new credit cycle. You get new assets being constructed. Interest rates go down, employment goes up, industrial commodities are bid, right? It's the Keynesian sugar high. Gold doesn't like that. Gold likes it when credit collapses. Gold likes monetary debasement. And I think that's more the story that we're getting now. Yes, of course, some of the Fed printing is going to the banks, as it always does. But the difference is now that we're getting repeated rounds of direct stimulus checks to consumers. And the consumers take these checks and they either go spend money directly buying consumer goods. And this is why food, for example, is going absolutely crazy. And also other consumer products. I was in the bike store a week ago. They told me that the prices for next season are up 20 to 30%. Not 2% CPI. So that's the kind of thing that all this money printing is doing. And that's a really hard thing to get back in the box. The way you shut off a credit cycle, as everyone knows, is the Fed dials up interest rates. And then all those loans that people took out become harder to maintain. And then things cool off and crash usually. How do you get back the stimulus checks? There are people out there, especially municipal workers, who haven't missed a paycheck. And all of a sudden they get a check for them, their wife, and all their kids. That's a lot of money. And they're either buying things or they're putting in the Robinhood accounts and chasing out the hedge funds. So I think that money is here to stay. And it's a very different animal than what happened in the last credit cycle. And that's why I think that the dollar is going to stay permanently lower. And of course, long term is going much lower. The question is, how much of a credit impulse can the Fed create at this point to get some relief to these trends?
I wonder if gold reacts more to the rate of change, the delta, so to speak, of, let's say, the dollar versus just the level. Let's say, like you said, the dollar is going to stay low, but let's say it just stays low and it's just flat and doesn't really go anywhere. Maybe there's no impulse there, right? There's no change there, so gold's not going to react. Would that happen?
Technical people talk about is negative interest rates, right? When inflation's running hotter than the nominal yield, then you get negative rates, and people don't want to obviously own a currency where they see their purchasing power melting away, so they go into places like gold. Interestingly, and I think people miss this and part of the analysis, is if you look at the 70s, there were two giant spikes in the gold price. It wasn't the whole decade of gold going up very nicely and smoothly. It was two big spikes. Both spikes happened when the interest rates went very, very negative. Real rates went negative. But both those periods were when nominal rates were rising. So the Fed was increasing nominal rates. And I think my own theory about what happened was that if you think of the Fed's balance sheet, it's full of all these bonds that are very, very low yielding, very long-term bonds that are very, very sensitive to the interest rates. So when rates go up, the value of those bonds get absolutely destroyed. The Fed's balance sheet gets destroyed, and the way the market fixes that problem is it raises the gold price, and that re-stabilizes the Fed's balance sheet. So I mean, the rates have been creeping up, and that's been negative for gold. But I think, again, the CPI story is the unknown story. As we all know, CPI has been manipulated and fixed, so it doesn't seem as bad as it really is. But everyone who goes to the grocery store knows that inflation is running a lot hotter than 2%. So I think that trend's going to continue. I think it's going to get worse. And so I think that again, if you think about real rates, they're getting ever more negative. And think about it, there's no way the Fed can raise rates up to where they were before. I mean, the federal government has so much debt now. They're the biggest debtors, right? They will blow up first, and then banks would blow up, and the whole system would unwind. So they can make noises, they can have rhetoric, they can tweak a little bit, but there's no way they can have a sustained increase in the interest rate without blowing up the whole system.
Well, what if inflation runs higher than expected? What if it goes up to 4 or 5%? Wouldn't the Fed be forced to raise rates?
Yeah, well, that's the problem they have, right? That's exactly where they're heading, and that was the problem they had in the 70s. And anytime, I mean, like in the 70s when they raised rates, airlines started blowing up and banks started blowing up, right? I mean, there were all sorts of problems because everyone's so levered to the gills. And again, unlike then, this time the leverage is much more intense, and it also the government is much more levered than it was even back then. So I mean, that's the box they're going to get into, right? Is that inflation's running hot, and if they try to raise the interest rates, the financial markets will blow up. And so what do you do? And there's another point about that, which I think is very important about the 70s, because I think that's a good model to think about. And that is, everyone knows still in the economics textbooks that talk about the oil embargo and how that made oil prices go up, right? And that's true, that was the trigger. But if you look at oil prices over the decade in gold terms, they don't really move that much. Right, so that was a catalyst to put oil prices back where they should have been on a monetary conditions anyway, right? And the reason I bring it up is because right now there are all kinds of industries, like the steel industry, for example, where prices are going absolutely bananas. And people think, oh, gee, this is just 2008 again. They're going to crash again. I don't want to raise the price of my consumers because I know they're coming down again. So what's happening is they're just limiting everyone to their supply. So you got all kinds of supply chain issues, right? But the point is that I'm not sure that's true. I don't know that steel prices ever come back down again. The way oil prices never came back down again in the 70s, even though the embargoes ended, right? I think that all this money printing, it has a tremendous effect. Again, as we discussed offline, the big story in 08 was M0. You look at those charts, and M0 just changed dramatically. It is this hockey stick, kind of graph. Now it's M1, or an M1 are check deposits, and money you can actually spend in the economy buying things, and that's going to push prices higher.
Mm-hmm. Yeah. Okay. So let me just try to understand this, Dan, because I think that the key point here is that, are you saying we only have two possible outcomes that we could face? One, inflation running out of control, and two, the second option, is a financial system blowing up because interest rates rise, right? Either we have run out of control inflation, or we have interest rates rising and everything blows up.
You know what, and I don't want to sound too hysterical because we're not there yet, but when you read the history of Weimar Germany, that's exactly the problem that the Reichsbanks had, right? Inflation went bananas, they wanted to raise rates, but they knew if they did, the banks would blow up, and they were too scared to do it, right? And that's exactly where we're headed. Now, it's a very mild version of that story, but yeah, that's the point. And keep in mind that senior economists like Rogoff and the people, they actually want inflation. They say, look, if we have a big burst of inflation, it'll wipe off all the debt on an aggregate level, and won't that be wonderful, right? And so that's what they're angling for. The problem is what they don't realize is that when inflation comes, things happen like food prices go up higher than wages do, and so workers get crushed. Businesses sell something and they got to buy replace their inventory, and all of a sudden it's more expensive. So working capital gets destroyed. So it's not the macro story where all prices change and debt just disappears. It's a dynamic that destroys all sorts of people in the economy. And what you wind up with is a bunch of rich people who know how to maneuver their way through it, and everyone else is very poor. And that's what you find in third world countries when you go there with lots of inflation. The middle class is gone. You've got lots of poor people and a few oligarchs. And that's, again, where the U.S. is heading under this system.
One of the questions I've seen is that whether or not we still have the money velocity in the economy to pump up inflation right now. If you look at money velocity over the last 2 quarters, it's actually been very low. I don't know, the latest quarter data hasn't come out yet. But if you just look at 2020, it's plummeted because GDP has declined, and the money supply has shot through the roof. So velocity just wasn't there. Do you see that?
Yeah, velocity, by the way, velocity is a number that you derive from those metrics. There's no independent way to measure it. I'm not a monetarist, so I don't think velocity isn't even coherent. And I'm not going into that story. But basically, again, what the story to me is that and the amount of money, M1, that is available to be spent has gone up tremendously. And as soon as people figure out prices are going higher, they're going to spend it. That's what I'm doing. I mean, I'm trying to spend money as fast as I can on heavy items. Because of the spirit. And by the way, when the Democrats, they're trying to bring all the wonderful union conditions in the North to the South, right? They want to get rid of the right to work laws. What's that going to do to manufacturing prices, to car prices, anything manufactured in the South? When you have supply chain issues, commodity price issues, and then you got union issues, I mean, the prices are going to absolutely bananas.
So what you're saying, this is like a self-fulfilling prophecy, right? We think there's going to be inflation, and so we buy things now, and that's going to drive prices up.
No, I don't think so. I think it's the opposite. I think the Fed has printed a ton of money because look. The last year, the government said, "All right, you can't work. You're not allowed to work. You got to stay in your house, right? Well, you got to eat." So they said, "Okay, we'll give everyone free money to eat." Okay, that's great. You get the money, but when you get money without being productive, or the only thing you do is push prices higher. I mean, Say's law basically is that society cannot consume more than it produces. So again, if you produce less, as we did as a society, everyone's stuck at home, and you're trying to consume the same, so there's no pain, well, you're going to have rising prices. So I think it's just that simple.
Yeah, let's talk about the components of prices here. So you talked about food. Yeah, I agree. Food's gone up. Energy, some guests think energy prices will go up this year as well. Interestingly,
especially if you can't drill and develop energy projects in the United States, that won't help.
Yeah, that's right. What about housing, Dan? I've been reading some reports about this exodus out of major cities like LA, and people are just, rent in LA has gone down recently, and just because people are moving out and working from home, and some people can't afford rent in big cities anymore because of COVID.
They will be able to soon.
What's happening? Housing is a big component of our spending. If that goes down, I mean, would that impact other prices as well?
Yeah, but don't forget that housing doesn't produce anything. I mean, Adam Smith talked about this. People think of houses as a capital. It's not. It's a huge expense. I mean, it's like having a nice car or coat. I mean, it's useful. It's nice to live somewhere, right? But it doesn't produce anything. You live there, you produce something else. So one of the confusing things about CPI is it mixes different things. The food, right, is something you need to live on, and clothes and energy you consume and you use, right? Housing is put in the asset bucket. And so what's happening is because rates are so low, people are building too many houses because it's so easy to finance them. And don't forget that all the people who invested in overbuilding in the cities, like New York City, where I lived until a few months ago, I mean, every third block had a skyscraper going up. Someone owns that thing, right? I mean, some bank lent against that project, and the cash flow they're going to get from that project is going to be very, very much lower than what they were expecting to get. Perhaps not on a nominal basis. I mean, you print up money, then prices go up enough, you can repay your debt at nominal terms, right? But in terms of real return on your capital, that's going to be a disaster. And meanwhile, again, you have tremendous building in the non-cities because interest rates are so low, and you wind up with overcapacity again. I mean, the last time I was in Florida, which isn't recently because you can't get there right now. It's hard to get there. I was driving around, and there were just huge real estate projects everywhere. I mean, everywhere, because mortgages now are 0% down again, and the rates are so low. It's really easy to buy a house. So that's the problem with inflation is that there's inflation economics is that there's overbuilding in some areas and underbuilding in other areas. And again, back to the main point for gold investors is that people think that during inflation, prices just they float up in a very even way. And if you get the trend right, you make a lot of money. And that's not how it works. In inflationary markets, prices become more chaotic. And you look at the 70s, prices became very, very volatile. And if you think that you can figure out where they're going, you lever up to get there, and the prices go the wrong way temporarily, like they are now in the gold price, right? That's extremely painful. So I think that this is all going to play out. It's very simple. You put the money, the prices go up. But the method, again, is very difficult, and you've got to be very careful in how you play that story. Okay,
just one more question on the housing, because what you said was very interesting. Let's assume housing prices go down. Okay, let's just make that assumption, okay? I find it's very interesting. I've observed that when prices go down, homeowners think they're poor, and so there's a direct correlation with housing prices and spending. They spend less, homeowners. Now, if you're a renter, you all of a sudden have, if your rent goes down, you all of a sudden have more disposable income and you buy other things, and so those things get pushed up. So is housing going down actually a deflationary, inflationary event?
Well, it's a great question. It's hard to know, right? Because on the one hand, you're right, the renter is better if it goes down. On the other hand, who owns the house, right? I mean, maybe it's some private equity guy that has some pension fund invested in it. And so the pension fund gets wiped out. So now the retiree has less money, right? It's not a free lunch. I mean, again, go back to the reality that everyone thinks of housing as a capital asset. You buy it the mortgage, you lever it up, it goes up in price, you make a ton of money, right? That was the story of the 2000s. And really, for the last 80 years almost, right? And yet, when you think of what a house is, it's a durable, it's a consumption item, right? And to maintain the house from falling down takes a tremendous amount of money, as I'm just discovering as I'm a new homeowner. And every time I turn around, I got to pay money to keep the thing from falling down. So it's something that, again, like China has the same problem. You overbuild these ghost cities everywhere, and it's great. But year 5, 6, 7, 8, the maintenance bills eat you alive, right? And someone owns that asset, and the guy who owns that asset has to take the loss when the prices go down because of overbuilding. Okay. And that, again, the guy who owns that asset is probably levered up 20 to 1, right? That's what the story of 2008. Maybe they're not levered 50 to 1 anymore, but they're still levered up tremendously. And that puts a big hole in the balance, in their balance sheets, and the Fed has to ride to the rescue and print the money and bail them all out.
So gold now. Let's go back to gold. You gave your long-term outlook and your long-term macro justifications. Fair enough. Sure. What about this year now? It's kind of been stuck for the first month at least. What about the remaining 11 months, Dan? Do you have any ideas to, up, down, sideways, what's going to happen?
Yeah, I mean, I try to avoid the short-term predictions. The reason is because the only guys who have a good sense of where it's going short-term are the guys at the bullion banks. Right? They see the order flows, they know the liquidity is, right? And as we all know, look at GameStop, right? Is it a value thing that's changing the stock, or it's all liquidity flows? And so unless you're sitting there viewing those liquidity flows, it's hard to get in front of that. So what I try to focus on is where I can, beat the market, and that is the long term. The long term, again, is that you look back through 5,000 years of history, the story is always exactly the same. The money printing has to keep accelerating to keep the system from falling apart. And if you look at a graph of the monetary base, for example, from 1960 to today, it is a power curve. I mean, the rate of increase is increasing, and there's no way to get off that. When they tried to taper the balance sheet, as Mnuchin was trying to do, right? What happened? The repo market blew up, right? And they had to start printing billions of dollars to maintain the repo market. The repo market being the primary funding mechanism for the state, for the treasury bond market, and the housing market. You go back to 2005 and 6. Few people, care to look at, but the Fed actually was slowing the growth of their balance sheet at that point. They thought they printed too much money coming out of the internet bubble crash. Right, and we're trying to taper that off, and then 2 years later, the housing market blows up, right? And so the Fed, oh my God, they got to print all the money to get back on that power curve. So yes, so the point is that as you get deeper and deeper into this wormhole, the rate of printing has to keep accelerating to keep things going, and that's why gold being much higher is a pretty safe bet, but. On the short term, again, the volatility can kill you. You look at Weimar Germany, again, extreme example of this phenomenon. You look at gold prices. There were months where gold was negative in nominal terms. That was during a hyperinflation. Imagine that. Your bratwurst is going up by 10x. You think this is easy. You buy a bunch of old leverage. It goes down. Oh my God! And then you get a margin call, and you're out of it, and you lost all your money. Right. So you've got to be really, really careful about the volatility, not taking you out of the trade on the way to where we know it's going, and that is much higher level.
That's a good question. I haven't looked into it myself. What happened to gold during the Weimar Republic, during the hyperinflation period of the 20s?
Yeah, I mean, it went to infinity, right? But it did not go there in a nice smooth curve. Actually, it's fun. If you zoom out, it looks like a nice smooth curve. Then you zoom into a month-to-month price change, and it's more and more volatile the higher it goes. And because remember, gold wasn't really moving. I mean, the mark and the pound, so the pound and the dollar, they were all tied to gold. They weren't going anywhere. It was the mark that was crashing, and the more the mark crashed, the more volatile the mark was getting. And again, you got to go back to think about the gold price in terms of dollars. It's not gold going up really. It's the dollar going down. So you're betting on how fast the dollar going to go down. And there are other factors involved. Like, for example, I read recently that I think there are $13 trillion of US dollar debt that has to be refinanced this year. Okay, where's that money going to come from? If the Fed doesn't print it, you're going to have a big liquidity crunch. So the dollar can get really strong because there aren't enough to go around. Well, how long is that going to last? How long is the Fed going to let the dollar gets super strong, and the banks blow up, and the government that needs to borrow, dollars, more and more, faster rate blow up. I mean, I don't think it's very long. In 2008, it took them a year basically to flood the market liquidity to get things going again, right? Last year, it took a month. All the 18 months of programs they developed in 2008, they rolled over in a pace of 10 days. And so my point is, I think we have a big liquidity crunch, but the Fed has their playbook. They're going to print the money. They have to print the money, or the whole system blows up.
The final question. Here's a thought that just came to my mind. What if gold in the future doesn't really respond to the dollar anymore? What if another currency takes the dollar's place as a de facto currency, and gold maybe hedges more against the yuan or the euro? Or maybe dollar debasement isn't what we should be looking at anymore. 10 years out.
Well, let's just stop right there, right? Because the point is that I don't think gold ever stopped being money. And I'll point to one fact all we have time for. Oil prices today are more or less what they were in the 1960s, right? They haven't really changed. But that's not the important thing. The important thing is, if you look at the volatility of oil prices in gold terms over the last 40 years, it's less than in dollar terms. So gold still behaves as money. And no one calls it money, but it still behaves as money because it's the most liquid element. And so the fact that Nixon took the dollar off the gold standard, there were congressmen who thought that gold was going to crash because it didn't have because it wasn't the gold, the dollar wouldn't be backed by anymore. No one wanted the gold. And that was the opposite. The dollar crashed, right?
Yeah.
And so all these other currencies, what the Chinese and Russians have been doing have been buying tons of gold. Why? Because they're worried the dollar collapsing. They want to have strong currencies when that happens. So I mean, gold underlies all these monetary systems. It's not very visible, but it's there.